Okay, let's unpack this. We are diving deep into a financial situation in Nepal that, honestly, it feels less like a standard economic problem and more like a paradox.
It really is. On one hand, you have this huge national agenda for growth.
Right, entrepreneurs, infrastructure, modernization, all of it.
Exactly. And on the other hand, a powerful banking sector that's almost paralyzed by caution. It's hoarding the very capital needed to fuel all that ambition.
And the symptom of this, the big headline number, is a $2 billion liquidity gap.
An estimated $2 billion gap, yes. And we have to clarify right off the bat for you, the listener, what that means. This isn't about empty vaults.
It's not that the cash has just disappeared into thin air.
Not at all. It's capital that exists. It's right there in the system, a huge pool of money, but it's being strategically withheld. It's essentially a frozen asset.
Inaccessible.
Completely inaccessible to the private sector that needs it most.
So our mission today is pretty clear. We need to analyze this structural dysfunction. We need to figure out why the usual tools, the policy levers from the central bank, the NRB, are just completely failing to unfreeze this capital.
And we also have to look at what the sources are pointing to as the inevitable outcome.
Which is a massive mandatory consolidation of the entire banking sector. And we even have a timeline for that.
You do. And if we connect this to the bigger picture, what we're really seeing is a classic case of, rational individual decisions leading to a collective bad outcome.
So a CEO makes a decision that looks perfectly sound for their bank's quarterly report.
But when every CEO does it, you get system-wide paralysis. It's an economic blockage that stems entirely from this internal defensive logic. And we need to dissect that logic first.
Okay, so to understand the problem, let's first define what a healthy system should look like. What is liquidity in this context?
In a healthy Nepalese context, liquidity should be a dynamic reservoir, a constantly moving stream.
Fed by what? Customer deposits?
Primarily three things. Yes, your traditional customer deposits. Then the really critical one for Nepal, which is the torrent of remittance inflows.
The economic pillar.
The absolute pillar. And third, the interbank lending market. This reservoir should be constantly suckling money into productive loans for growth.
But right now, the sources are describing it not as a stream, but as a stagnant lake. That $2 billion isn't gone, it's just sitting there.
It's being strategically redeployed into inaction, essentially.
I want to stick on remittances for a second, because that's so unique to Nepal's economy. When you say it's the lifeblood, what does that actually look like?
It means money sent home by Nepalese working abroad is just fundamental to the economy. That money comes in, it hits a bank as a deposit.
And it should then be available to be lent out.
It should. It's what allows Nepal to cover its import bills and fund domestic spending. That constant flow of foreign exchange should, in theory, keep the banking system flush with capital.
So given that constant inflow, why are the big players, the Class A commercial banks who control most of the assets, why are they hoarding it? Where's that capital actually going?
They're channeling it into the safest place imaginable.
Which is?
Government securities. We're talking virtually risk-free instruments like treasury bills and development bonds. But it's not just that. They are also dramatically over-reserving their cash, holding buffers well above what the NRB mandates.
Okay, wait. For listeners who aren't bankers, can you quickly break down those mandatory buffers, the CRR and SLR?
Of course. There are two key ratios. First, you have the cash reserve ratio, or CRR. That's the slice of a bank's deposits they have to park physically with the central bank. It's their emergency fund.
And the second one?
The statutory liquidity ratio, or SLR. That's the percentage they have to hold in super safe, highly liquid assets. And often that means those very same government bonds we just mentioned.
And the sources say the big Class A banks are exceeding these ratios by a lot.
By a massive margin, by holding far more than the law requires for both CRR and SLR. They're sending a clear signal.
What's the signal?
The signal is, we trust the government's debt far more than we trust a new business loan, no matter what interest rate you offer us. It's pure institutional risk aversion. That's what's soaking up that $2 billion.
And the institutional memory that's driving this, that's the post-2015 credit cycle, right? When they lent really aggressively into real estate.
Exactly. That period led to painful, truly painful surges in non-performing loans NPLs. The bank boards got burned. They were scarred by the losses.
So they changed their whole strategy.
Completely. They shifted from growth at all costs to capital preservation at all costs. They know that a 4 or 5% NPL ratio is a much bigger threat to their stability, to their stock price, than missing some government lending target.
So parking money in a sovereign bond with almost zero default risk just becomes the most logical defensive move they can make.
It's the only move they feel they can make.
Which brings us right back to that core tension. An individually sound decision to protect capital leads to the collective starvation of the entire system. Everyone's preparing for a storm, but in doing so, they're actually creating the drought.
That's the paradox in a nutshell.
Here's where it gets really interesting, because the Nepal Rashtra Bank sees this hoarding happening, and they've tried to fight it with a tool called directed lending.
Right. These are mandates. They force banks to allocate a certain percentage of their loans to what they call priority sectors.
Things like agriculture, renewable energy, small and medium enterprises, SMEs, the real engines of growth.
And that top-down approach, it used to have some real teeth. But the sources are showing its foundations are cracking now because of a fundamental misalignment of incentives. It all comes down to risk-adjusted return.
So policy aspiration versus commercial prudence. Break that down for us. What does an analyst at a Class A bank see when they compare, say, an SME loan to a government bond?
Okay, so they're looking at the total picture, not just the interest rate on the loan. Let's say a high-risk SME loan is offering a 13% interest rate.
Sounds pretty good on the surface.
It does, but the analyst immediately factors in the high probability of default for a new business. Then there's the huge administrative cost, the legal fees for recovery if it goes bad. Servicing hundreds of tiny loans is a massive operational burden.
So that 13% gets eaten up pretty quickly by risk and admin costs.
Exactly. Now, contrast that with the alternative, a sovereign bond. It has near zero default risk and a guaranteed 8% yield.
That 8% is clean. No admin, no risk of it turning into a toxic asset on your books.
Precisely. So that guaranteed 8% starts to look far, far superior to the risky 13% that could become a massive NPL headache. It's the logically superior choice for any manager protecting their balance sheet.
And as a result, these NRB directives, they're now seen as more of a risk tax to be minimized, not a serious guideline for development.
That's the perfect phrase for it. And it leads to this behavior of creative compliance.
What does that look like? Gaming the system.
Pretty much. They meet the letter of the law, but they completely violate the spirit. They'll lend, but only to the most established, asset-backed, low-risk players within that priority sector.
So the biggest commercial farm, not the small agri-tech startup.
Exactly. They are checking a box, not actually changing their risk profile or helping the people the mandate was designed for.
And are things so bad that some are just paying the fine instead of lending at all?
That's the most alarming part. The data shows some banks have done the math, they've run a cost-benefit analysis, and they've found it's actually more cost-effective to just pay the NRB's fine for noncompliance.
Wow. So the fine is cheaper than the potential NPL exposure.
The fine often wins.
That disconnect, where the central bank's steering wheel isn't connected to the engine anymore, that feels like the biggest single impediment to growth right now. The policies are just failing because the incentives are all wrong.
They're completely tilted towards safety.
So while these huge Class A banks are safely hoarding capital, their actions are having these massive ripple effects, right? It's destabilizing the smaller players.
Oh, absolutely. We need to talk about the Class B development banks and the Class C finance companies.
The last mile providers.
Yes, the ones serving the smaller, often overlooked customers and SMEs. Their entire business model makes them acutely vulnerable to what the big banks are doing. They're getting hit by a dual squeeze.
An existential threat, the sources say.
It is. So mechanism one is about the interbank market.
Okay, what happens there?
When Class A banks tighten their grip on liquidity, they're obviously less willing to lend it overnight to smaller, riskier Class B and C institutions. This scarcity drives up interbank rates, making that short-term funding they rely on for daily cash flow prohibitively expensive.
So their funding dries up or gets way too costly. And what's the second mechanism of the squeeze?
It's their internal risk profile. That's mechanism two, concentrated risk. Unlike the big commercial banks, they aren't diversified. Their loan books are heavily concentrated in those exact sectors that are now considered high risk.
SME financing, vehicle loans, personal lending.
The very loans that are the first to sour when the economy slows down. So they feel the pain first, and they feel it the hardest.
And as their NPLs climb, their capital adequacy ratios must just plummet.
Which kicks off a brutal, vicious cycle. Rising NPLs make it almost impossible to raise fresh capital or get affordable funding, so they're forced to cut back on lending, which hurts their profitability even more.
They just don't have the scale or the giant capital buffers the Class A banks have to weather this kind of storm.
They don't. The current environment isn't just a challenge for them. For many, it's pushing them to the brink of collapse or a forced acquisition.
It sounds like the whole system is splitting in two. You have a small group of very strong, very cautious players at the top, and then this much larger group of essential but increasingly fragile players below them.
That is the perfect summary of the paradox.
So this trajectory is clearly not sustainable. You can't have a developing economy with ambitious goals when its financial system is blocked like this. So what does this all mean for the future? Where do the sources point us?
It means that the fragmentation of the banking sector itself, a legacy of a time when lots of B and C licenses were handed out, is now seen as a systemic liability.
It can't support the country's ambitions.
Not in its current state. And the policymakers at the NRB, they know this, which is why the forecast is shifting away from just gently encouraging voluntary mergers.
To mandating them.
To mandated structural intervention, yes. No more polite suggestions. We were talking about compelled mergers and acquisitions.
And there's a timeline on this.
The consensus is that the central bank will roll out a formal, mandatory consolidation framework by the fourth quarter of 2026.
That's about 2 years. It sounds like both a warning and a deadline for the market to get its act together.
It is, and the difference between merging now and being forced to merge then is huge. It's about control and valuation. A directed initiative means the NRB will force weaker B and C institutions to merge or be bought by a larger Class A bank, probably at a steep discount.
So for a CEO of a smaller bank, the choice is stark. Find a partner now while you still have some negotiating power, or wait and get forced into a bad deal later.
It's a race against the regulatory clock, and that clock is ticking very loudly right now.
Let's bring it back to the end user. The borrowers, the entrepreneurs. Does this consolidation actually help or hurt them in the long run?
Well, it's a trade-off. Initially, it's a threat. The disappearance of smaller, more agile lenders definitely reduces options for borrowers. There are fewer places to go for a loan.
And fewer lenders who really understand small business financing.
Right. But the long-term opportunity is that you'll end up with larger, more stable, better capitalized banks that could eventually provide more consistent, large-scale credit. The lending will be much stricter, more standardized, but potentially more available. You trade agility for stability.
So the hard truth we've uncovered here is that this fragmented system has become a risk in itself. It's actively blocking growth. The pain and the disruption from this coming consolidation, it seems like it's the necessary price to build a financial system that can actually support Nepal's ambitions.
Absolutely. And as you, the listener, consider this whole dynamic, you should ask yourself this provocative thought. Given this policy paralysis and the bank's fear, how long can a developing economy rely so heavily on that lifeline of remittances to mask these deep structural flaws?
And what happens when that lifeline inevitably tightens?
Exactly. What happens then? It's really worth looking at the historical parallels of mandated banking consolidation in other developing countries. Nepal isn't the first to face this reckoning, and there's a lot to learn from how others manage the pain that comes with it.